We learned nothing in this country. We learned how to make the situation a lot worse because asset bubbles. That's what we did. We learned how to build asset bubbles over and over and over again. Bubbles are created, money supply booms, the middle class gets eviscerated, the rich get richer, and the poor get poorer. That's not my opinion. That's a fact. That's what's happening. I don't care what anybody else says. The stock market is extremely overvalued. It's by many metrics the most overvalued, concentrated stock market in history.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Michael Pento. Michael is the founder of Pento Portfolio Strategies. He possesses over 35 years of experience in financial markets and investing, and he's also an author. Michael, thanks so much for being on the show today.
Pleasure to be with you, Christian. And I have to say it's 35 years, not over. Don't make me older than I am, please.
Fair. Love to start off asking you, what's your current take on the global economy and financial markets?
Well, the global economy is weak, and it's not just tariffs. And the U.S. economy, according to the Atlanta Fed, is growing at a negative 1.8% this quarter. So what we had been enjoying is the top quintile or top 20% of households have been keeping the economy going. They own 90% of all equities. The 90% of all equities is a lot, by the way. And they control 50% of all the real estate in this country. So the top 10% of income earners, a very concentrated position in wealth in the United States. And they've been clinging to asset bubbles. That's what's keeping them going. So stocks and real estate. And if you see what's happening in real estate, the supply of new homes for sale is surging, especially in those hot areas that everybody moved to in the wake of the COVID crisis. Home prices are starting to roll over month over month. And I think that function is going to intensify. So they're losing money on their real estate assets, and they're really going to lose, and they are losing money on their equity portfolio. So the wealth effect is going into reverse. You couple that with the tariffs and the decline in the labor force, with inflation that has absolutely eviscerated the bottom four quintiles, bottom 80% of Americans. You'll see that the economy is very, very weak. It's not yet what I think is in a recession. It could be close, but we're not falling off a cliff yet. So that's my assessment of the economy.
Gotcha. And then could you share and unpack where we are in the, more in the current economic cycle for those that are not, perhaps intimately familiar with your take on it?
So how I manage money. I look at the second derivative of inflation in the context of growth. So inflation has been extremely sticky. As a matter of fact, Christian, what I find very amusing is that inflation has been above the Fed's asinine, as I'm fond to say, 2% target for 4 years. And by their own projections in their latest FOMC meeting, which was March, they said that inflation might return to 2% by 2027, which means that they will have missed their inflation target by 6 years, if they're correct. I think that's terrible, because why would their central bank, which is charged with keeping prices stable, allow inflation to be above, not above zero, above 2% for 6 years? And yet they're still in a rate cutting cycle by their own an avowed rate cutting cycle by their own admission. So we have inflation that's just been very, very sticky. It's like I said, has really eviscerated the middle class of this country. And yet we see growth slowing. So there's a word for that. I didn't make it up, but there's a word for that. It's called stagflation. It's a very, very awkward condition to be in. I predict, due to liquidity coming out of the stock market, and by liquidity, I mean reverse repo facility, by the Treasury General account, by the real Fed funds rate, by bank lending standards, by the Fed's balance sheet, liquidity is constrained, which always is, liquidity is a lagging. It works with a lag, but liquidity is coming out of the market, and that's going to be reported with a lag. But I think disinflation and deflation could be in the cards. as opposed to the stagflation we see now.
I see. And as it relates to geopolitical risk and policy, would love to have you kind of share your thoughts on a couple questions that I have. Starting off with, given current geopolitical tensions with regards to Ukraine, Taiwan, Middle East, et cetera, what is most concerning to you as it relates to market volatility?
What's most concerning to me? I look at the second derivative of inflation in the context of growth. I don't see any existential, World War III crisis breaking out. But you look at tariffs and you look at some of the things coming from the Trump administration, like annexing Canada and taking over the Panama Canal and annexing Greenland. I mean, these are things that aren't helpful on one hand. On the other hand, what he's doing, I think, is very helpful. Is trying to create peace between Ukraine and Russia. I think it should be a very easy solution. Just give the Donbass region to the Russians; they can keep that, and then the Russians would leave Ukraine. Ukraine would promise not to make that nation part of NATO, so Russia wouldn't feel as if they had an existential crisis looming on their doors. And then the United States would help Ukraine rebuild. I think it's the best. I don't understand, and that's what Trump meant when he said he can end this war in a day. I think that's a great solution, and would take the odds of World War III, to bring them way down. So I hope and pray that happens. No, hopefully not. And then you have the Gaza and Israel, Palestinian issue. So that's one of the most horrific things that's been going on for decades, if not centuries. So I don't really see a resolution to that very easily either. However, I did notice today is there were massive protests in Gaza from Palestinians saying to end the rule of Hamas. That would really be a blessing if we could get Hamas out of power, and then maybe have some, statehood for the Palestinians and some peace between the Israel and Palestine. That would be wonderful. We'll pray for that too.
Any comments as it relates to over in Asia or anything of that nature?
Well, I mean, one of the countries that's the biggest offender as far as Trump is concerned with our trade deficit is China. Trump is trying to do the right thing, in my opinion, as far as these tariffs are concerned. We need to rebuild the middle class of this country. We need to rebuild the manufacturing base, because it's also a matter of national security. I mean, if we had a war with China and we didn't have any rare earths, or if we didn't have any ability to manufacture pharmaceuticals and weapons or medicine, then that's a existential crisis for the United States. So we want to build that manufacturing base here in the United States. Of course, that's going to really negatively impact China. So I see the antipathy between the two countries as escalating. And of course, if they were to annex Taiwan, it would be a real issue. So I don't see any solution. That is a much more difficult situation. That is an escalating problem, whereas Russia and Ukraine is a de-escalating situation, in my opinion.
I see.
By the way, in case you were interested, I'm not a political expert or a geopolitical expert. I manage money for a living, and I look at that second derivative of inflation in the context of growth. Now, could the geopolitical conflagrations affect that? Absolutely, and they do. So that's where my focus is on. Other than I always pray for peace.
Gotcha. And as it relates to policy shifts, whether that's pertaining to the U.S., EU, or BRICS nations, could you share any thoughts as far as anything else that could trigger volatility or structural changes in the financial system? Well,
you can see the tariff. I mean, we just put a 20% tariffs on all automobiles that are not made here in the United States. I don't really, I'm not exactly sure how it's going to work, because if I was suppose I was General Motors, which I think the stock was down like 6% this morning or 7% this morning. If I was GM and I'm importing vehicles made in Mexico, I would like leave off a windshield wiper or something. And I would say, well, this is not a finished vehicle. It's going to be finished here in the United States. So it's not subject to tariffs. In other words, Christian, I think there's going to be a lot of games that are going to be played. So, and I wouldn't just automatically assume that every car manufactured overseas, like, a Maserati, is now going to be 25% more expensive, and a General Motors car manufactured in Mexico is going to be 25% more expensive. It's not that clear cut, because like I just said, there's going to be a lot of games going to be played as far as that's concerned. But also, the exporting country could eat a lot of those increase in costs. So there's nothing to pass along to the U.S. consumer. They also can depreciate their currency, which would also help to offset those tariffs. It could be eaten in margins to the importer, the U.S. importer. And then there's also, you could also buy other things that aren't, Americans can turn more to Teslas, which are 100% manufactured in the United States. So I'm not saying this is a automatic increase into inflation. As a matter of fact, tariffs have almost nothing to do with inflation. It could be, at the worst, they could be a one-time hit to the level of prices. That is not inflation. Inflation is when the holders of a fiat currency lose faith in the purchasing power of that fiat currency due to massive monetization by the central bank in order to make sovereign debt appear to be solvent. That's where inflation comes from. It's when a central bank monetizes currency, a fiat currency, to artificially manipulate interest rates lower. That's what happened post-COVID. Think about what happened post-COVID. So we engaged in helicopter money, sent money directly to people, told them not to go out and to make things and produce things. The money supply boomed by some 40, 50%. The Fed's balance sheet went from $4.5 trillion to $9 trillion, that's high. Think about that high-powered money, Fed credit. So money supply booms, and there's nothing to, there's much less supply of goods and services to absorb that money, and you have soaring prices. So the confidence, the faith in the fiat in the fiat currency's purchasing power was destroyed, and we're still living with that today, Christian. Look, as I said, 4 years after COVID and helicopter money has ended, we're still struggling with inflation because it's been inculcated into consumers' minds. And by the Fed's own admission, it won't be solved until 2027. So it's 6 years of suffering with inflation. And by the way, they measure it as 3%. It's really much higher than that because of substitution and hedonics. So that's my view.
As it relates to assets and things of that nature, could you share kind of your current thoughts and sentiment on the stock market and perhaps commodities and other asset classes?
Well, the stock market is extremely overvalued. It's by many metrics the most overvalued, concentrated stock market in history. And I don't just say that to be a Cassandra or to use hyperbole. I'll give you some facts. So the total market cap of stocks as a percentage of the underlying economy is 200%. The average of that metric is slightly below 100%. So you can make a case where the valuation of equity should equal the annual output of GDP, but it should never be twice the annual output of GDP, which is where it is now. If you look at metrics like price to sales, it's the S&P 500 is trading at 3 times sales. It should be 1.5 times sales. So by those two facts I just gave you, stock market should drop by 50% to be fairly valued. So some more data is the forward PE ratio is over 20 times earnings. And the 20 times next year's earnings, which are fictitious. This is just a guess. I don't know how earnings are supposed to grow 11% in that calculation. Stock market is 20 times 11% earnings growth this year. It's already trading there now. So I don't know how you get 11% earnings growth in a scenario where GDP growth is basically flat. It's very hard to do unless you say, well, the inputs, the producer prices are going to crater, and we just went over the fact that they're not. Their inflation is still a major problem. So you're looking at margin compression and top line sales growth that's nominal, and yet where are you going to get 11% earnings growth? But even if you did, the market's fully valued. So you got to be very, very careful, especially if you're buying those Mag 7, the Magnificent 7 stocks, where in the start of 2025, those 7 stocks comprised 40% of the S&P 500. That's the most concentrated. That makes the Nifty 50, and I think it was like 35% back then. Or even in the NASDAQ bubble, the dot-coms were 30% of the S&P 500. Now just those handful of stocks are worth 40%, which is ridiculous. So it's a very, very concentrated, overvalued, and dangerous stock market. And having said that, you might think I'm massively short the market. I am not. I'm still slightly net long, but I'm in the right sectors of the market. I'm in low volatility stocks. I'm in gold. I'm in short-term bonds, which are paying 4.25%. So we're doing fine with a lot less volatility. In other words, the risk-reward ratio, Christian, in my view, has never been worse. The risk of owning stocks is not worth the reward at this juncture.
I see. And then where do you think the next big dislocation or opportunity lies in the global markets? Perhaps something most people might be overlooking.
Well, having said all that, if you look at credit spreads, which are high yield bonds in relation to treasuries, they're razor thin. It's like less than 3.5%, like 3.2%. The difference between junk bonds and treasuries. Now, I think there's an unmitigated disaster waiting in the junk bond space, and that's where your opportunity is. So I have a very small short position in junk bonds. I plan on increasing that when my model signals it's appropriate to do so. But I think the spread between those two assets, treasuries and junk bonds, is going to widen in a significant fashion, which is, by the way, one of the best indicators of when the entire market is going to fall apart, which it has not yet. I mean, is the S&P down this year? Yeah, it's down like around 3% for the year. But many sectors are still positive. So the market and the sectors that we own, which are low volatility sectors, they're doing fine. So I can't make a case for the economy or the stock market imminently falling apart. But the conditions are right for those two things to do so. And that could happen in the near future, and that's what I'm looking at. So the next big opportunity is to short the market, in my opinion. That's the next significant move in stock prices are down, in my opinion.
Gotcha. And then as far as strategy and positioning, if someone wanted to position themselves to not just survive, but to thrive over the next 5 years, what core principles or strategies would you advise if you can kind of unpack and kind of dive into that?
Well, I don't know about 5 years. I mean, I look at next 3 months. No one knows what's going to happen in 5 years, so I don't look at that. But I will say over the next 5 years, say one thing that's very, very cogent and salient is you should be an active manager of your funds. Because when bonds and stocks and real estate are all in a bubble concurrently, you just can't sit there and buy and hold stuff. Like look at 2022. You say, well, your average guy, your average wirehouse money manager will tell you, hey, don't worry about a thing. Just buy stocks and we have the ballast of bonds in the portfolio. Everything's great. Well, wait a second. Bonds didn't act as a ballast in 2022. They went down more than stocks did. They both went down in price. So the yield went up in bonds and the price of stocks went down and the price of bonds went down significantly. So you didn't have an offset. You have to be an active manager because the boom bust cycles that I see coming, that have happened in the past and I see coming are happening more frequently and with greater intensity. And there's a reason for this. The reason's clear because we have an artificial, Christian, we have an artificial economy. We don't have a real market-based, if you had a real market-based economy, we wouldn't be subject to these huge swings, but we have a financialized economy. And that you can lay that right at the doorstep of government, the Treasury and our central bank. That's why we're in this condition. You ever wonder why home prices are so egregiously high that they're the most unaffordable in history? You think that happened by osmosis? The Fed's supposed to have your back. It's supposed to be in charge of building the middle class of this country. But the opposite. I mean, who gave the Federal Reserve permission to print trillions upon trillions of dollars in base money supply, high-powered money? Who gave them that permission? Why were they buying mortgage-backed securities in 2022 when home prices were up to 20% year after year? Who told them that was a good idea? And now all of a sudden you have people post-COVID, because they were buying mortgage-backed securities, were taking mortgages out at 3%. In the threes. So if I can borrow money at 3%, but inflation's at 9%, right? Real interest rates are profoundly negative. The calculation from Wall Street was, hey, I'm going to go buy and leverage up my balance sheet, borrow as much money as I can, and just buy huge tracts of single-family homes and rent them out. And that's exactly what they did. But now home prices have stopped going up because they're unaffordable. And you can't pay your taxes, and you can't pay your insurance, and you can't afford the maintenance, and you can't afford the mortgage. Home prices are starting to roll over, and now these huge numbers of homes owned by Blackstone et al. Are all going to be dumped on the market, and that's going to send home prices much lower, in my opinion.
Yeah, just to comment on, as it relates to where people are at and such. I've mentioned on other episodes that, I've been providing housing since about, 2020. And it's blown my mind how many people I've encountered who are, I'm in my early 30s, how many people who are, 20, even 30 years older than me are not in a good spot. And to me, it's really spooky that, that they're, having to find, housing and such. And so it just, I see it literally.
Yeah, I mean, if the average home price is around say 600,000, I don't know the exact median family home. It's not off memory, but I mean, down here where I live, it's maybe closer to $1 million. And then you say to your son or daughter, hey, listen, would you like to own a house? You need to find 20% down. Well, you need to save $200,000. To put a down payment. You know how long it's going to take these kids to save $200,000, or even if it's $100,000? Just say it's a $500,000 house. They have to come up with $100,000. $100,000 is a lot. So it's for most people that's half of a lifetime's of savings. In fact, for most people, they don't even have $1,000 in their checking account. But if you have a decent job, it's going to take you many, and that's just for many, many years, and it's 20% down. But don't worry, the government had a solution. They have something called PMI insurance. So you could just put, if FHA secure loan, you just put down 3.5%. What could go wrong, Christian? Home prices drop 4%. You're underwater on your house, and you can't afford the mortgage, and it's a jingle mail all again. So we learned nothing in this country. We learned how to make the situation a lot worse because asset bubbles. That's what we did. We learned how to build asset bubbles over and over and over again. And now we have three: equities, real estate, and credit. Three massive bubbles that are going to implode.
It must really get under your skin because you're so you're
Old?
in the trenches and you oh yeah. Well, I don't know if it
Sorry,
cut
I
out
got it.
there.
Yeah, I do. I'm sorry to interrupt because I got
Oh,
I
you're good. You're good. No, I was just going to comment that you're privy to a lot of the insights and such that's going on, and it must grind your gears as it relates to what goes on, what has gone on, and what is likely to continue going on, and how it's disrupting so many people's livelihoods.
Well, one of the great things about the United States is we're supposedly a free market economy. We believe in markets. And what is a market? What is capitalism? What are markets? It's when governments don't tell you what to do or buy or sell, and major oligarchies don't do that. The people decide what to buy and what to sell. They vote using their own wallets, their own money. That's a free market economy. So you think about what the Fed has done in distortion of one of the biggest price signals, if not actually it's the biggest price signal in the economy, is the cost of money, which or AKA interest rates. If you have a country that's got $36 trillion in debt, and if you have a country that's 123% of GDP, debt to GDP, national debt to GDP, interest rates should be a whole heck of a lot higher. $2 trillion annual deficits, $1 trillion in interest payments. But interest rates aren't a lot higher because you know who owns the debt? A lot of that debt? It's not the free market that's pricing that debt, not you, not me. It's the Fed. Look at the Fed's balance sheet, still hanging around, just below $7 trillion. The Fed is an, agnostic buyer. They just print money and buy debt from banks, and private banks go out and buy more debt and more mortgage-backed securities, and the interest rates are falsified, pushed well into negative territory. Asset bubbles are created. Money supply booms. The middle class gets eviscerated. The rich get richer, and the poor get poorer. That's not my opinion. That's a fact. That's what's happening. I don't care what anybody else says or what anybody else's opinion is. That is the dynamic that has gone on in this country. And yes, it does get under my skin. Because you know what? If you care about this country, any country that wants to have a viable existence needs a viable middle class. Strong, healthy, productive middle class. Right?
Well, I remember Victor Hansen referencing that the middle class and how throughout history that's all. Well, I guess it hasn't always been around throughout history because you had different systems like feudalism and such. But how important that is in our day and age to have that. One last question, Michael. Is there anything else in particular that you feel doesn't receive enough attention? Any other thing that the audience should be more aware of?
Well, I can't answer that in just 1 minute. So I'll just say pay attention. I have a podcast that I put out. It's called the Midweek Reality Check. It's $50 a year if you can't afford to become a client, because to become a client of mine and have me manage your money in the inflation, deflation, and economic cycle portfolio, you need $100,000. You have to be suitable for the portfolio because it's a long, short strategy. I don't just buy stocks and go play golf, and bonds and go play golf. And you have to be a U.S. citizen. But I have a midweek reality check, and I'll give you the salient data of the week, analyze it, tell you my interpretation, which is an objective view of what's really happening. And if it's only $50 a year, and it's a 5-week free trial, if you're so inclined. That's what I would do.
Well, Michael, I know we only had so much time, but I appreciate you coming on the show. Thank you.
It's been a pleasure, Christian.